Hi, this is Nick. This is a short video on equity for those of you studying CFA Level 1. Now, equity, people often think of it as all about numbers and calculations and valuations. It's not. In fact, there are very few calculations in your Level 1 equity curriculum. Apart from some margin calculations and indices, there's really nothing till the final chapter. What we're looking at when it comes to this valuation, so I'm going to focus on this last area, the idea of valuation, because this is where we need to think the most. It's all to do with comparing price and value. Benjamin Graham, mid-last century, said that the best form of investing, what's called value investing, is all about buying dollar bills for 50 cents. If we can find an asset that's worth, let's say, this much, but we can pay rather less than that, then we have got ourselves a bit of a bargain. So it's price versus value. The price is easy. That's the price tag. What does it cost to buy a share? Value, that's more complex. There are lots of different answers. And the objective that we've got is to try and identify the intrinsic value of an asset. Intrinsic value meaning the true underlying value. And although we're going to be looking at this briefly in equity, it's something that's going to follow us through the whole CFA program, and for many of us, our entire careers. There are lots of different methods for doing this. And the three main methods we look at Level 1 are discounted cash flows, in particular dividends, though free cash flow is also mentioned, relative value, how expensive an asset is an asset relative to other similar assets, and asset-based, what's the balance sheet, what's the actual business worth in terms of its tangible value. The exam focus is very much the first one, discounted cash flows, and we're going to look at lots of different bits of algebra. You'll see this extended very much at Level 2, and many of you will be working on spreadsheet versions of this for much of your career. Now, one thing to note is all valuations that you calculate for a particular company are going to be different. Calculating intrinsic value is not an exact science unless you happen to have the best crystal ball on the market. For example, a company may be very asset rich with low cash flow, so the asset valuation may be quite high, but discounted cash flows may not be. Or it may be that it's very expensive relative to the market, but for a good reason. These key skills will be developed over the coming years. So think about what the different models are doing, and although in any one exam question you're only going to be given one particular calculation to do think about the bigger picture that it fits into.